Make Better Wealth Decisions, a podcast that explores how financial advisors' blind spots can harm your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. In this podcast, we'll provide advice on how you can achieve better outcomes by maximizing investments and minimizing taxes. Let's put our thinking caps on as we consciously decide to get smarter about our money. We recently had a meeting with Ian McGugan of the Globe and Mail talking about how people make better wealth decisions in the context of bullshift. And we've talked about bullshift a fair bit on this podcast, but I wanted to take some time to talk about how people might not always realize the biases that are inherent in the financial services industry. And they are a real risk to people as they make decisions. And I want to talk about it from both the perspective of the media, which is Ian's world, and the business of giving financial advice to retail clients, which is my world. Let's start with what we talk about with the media. The media has a role to play. And I have, in my career, spent many years working with the media. I've written many articles for a number of different publications. I've been quoted as a resource, as a thought leader, as a person who's aware of what's going on in the industry many times by the media. And I hold the media in relatively high esteem. They've got a job to do like anyone else. There's a problem, however, and that is the media, like any other industry, needs to get paid. And if you want to get paid, you have to do what the advertisers want. And if you're in the financial services media, where you are writing about investment products and strategies and ratings and opinions, it's useful to be able to have those ratings and products that you feature and viewpoints that you espouse be consistent with the viewpoints that your advertisers will also share. That, of course, creates pressure to perhaps be a little less than independent and to be perhaps somewhat biased in the way you approach things. I'm not suggesting that it's a big problem, but it certainly is a problem, and it's a live issue that has been part of what the industry has had to grapple with for generations. It's not anything new, but you need to be aware of it. So, for instance, if you pick up a newspaper or a magazine or visit a website that will do a rating or an article which says, these are the 5 ETFs that are the best ETFs for 2025, or these products are the highest rated in their asset class for the coming quarter or year or for this market. As soon as you see something where products can be rated or recommended, you need to be aware that the people that are writing the articles will be under some pressure from advertisers, from people that are going to be kind to the publication in one way or another, who will want their products or their spin, their viewpoint, to be taken into account and hopefully promoted, because that's the way the world works. I'm not suggesting this is anything new, but it's the sort of thing that a lot of people might not think of on a regular basis when they read, and they might take things at face value. So it is with financial advisors. Advisors will use certain products, and they will obviously recommend products that they think are best. There's a problem, however, in that a lot of financial advisors are not as independent as they say they are. Their firm will limit which products they can use. And as a result of controlling the product shelf, the tools in the toolbox, if you will, that will have an impact on what the advisor can recommend. And he or she may recommend perfectly fine products, but there may be other products that are as fine or better that are not being recommended for reasons that are opaque, for things that are not obvious to you, the listener, or you, the reader. And that is that their firm might not approve it, or there are certain products that pay commissions. And if the advisor is a commission-based advisor, which is to say an advisor who charges by getting commission from a product, when there are other products which, again, are as good or better that don't pay a commission, then we actually have the advisor's product recommendations being driven by the advisor's business model as opposed to the product merit. Now, that's not necessarily a problem, but it certainly could be. And it's certainly something that you, as a person who is a consumer of financial information and an investor in financial products, should be aware of. Bullshift is a live consideration, and the industry is frequently shifting your attention to make you feel bullish, because being bullish is a mindset that's good for business. Let's put it this way. if the industry is talking about all the great opportunities that exist in 2025, you'll likely want to invest now to take advantage of those opportunities. Meanwhile, if there are risks in the market, and believe me, as we record this in January of 2025, there are considerable risks in terms of valuation, in terms of the unknowns of AI, in terms of a threat of tariffs coming from south of the border, and other things that might be causing a recession, what might be happening with bank rates, debt levels for both Canada and the US, and for both governments and households. There are a number of risks that are very material, that are perhaps greater than they normally are in this environment in early 2025, but you will seldom hear the industry talk about it. Or if they do, they will talk about ways to navigate these risks as if they are minor and things that can be overcome relatively easily, instead of by talking about there could be a very real significant pullback here. And that's saying that there will be. This is not a forecast, but the thing that you need to think of is the industry is almost never going to have that opinion, because they want to keep you happy and they want to keep you investing. And in order to do that, the glass always has to be half full. That's not necessarily a problem, but optimism bias can be a material threat to your finances if you're not making a serious consideration to guard against it. And the industry seldom helps you to guard against it.
John DeGuy is a portfolio manager with Design Securities in Toronto. The views expressed in this program are not to be construed as specific advice. It is recommended that you consult a qualified advisor before taking action. His books, The Professional Financial Advisor 4, Stand Up to the Financial Services Industry, and Bullshift are available through Amazon and in bookstores throughout Canada. You can reach John at 647-STAND-UP. That's 647-782-6387, or at jdeguy@designedsecurities.ca.